All right. Welcome back to the channel. It's episode 5, day 5 of the boot camp. But wait, Daniel, I thought you said you were ending it yesterday. You posted that video. Well, clearly I'm done right now, so it looks like we're doing episode 5, day 5. Now, listen, just before you all get gassed up and get excited and whatnot, I wanna say a couple of things before we get started. Now, I'm not saying that I'm committing to this 30-day boot camp because I don't know. I don't know if I want to commit a whole 30 days uploading every day, but I am going to still continue to make educational content regardless, and I'm still going to put it in the boot camp format. Whether or not I choose to give you guys my entire system, my entire strategy, and my entire methodology, I don't know about that one. Again, I still believe it deserves more views, and I'm not going to devalue it. However, I will give you guys some still like price action, some knowledge. Like I can still teach you guys without giving you everything. You see what I'm saying? And clearly, judging by the last comments, like there's a lot of you guys that are actually here and you actually want to learn. So we're gonna get it running. However, what I am gonna say is for those of you guys who are actually serious, who actually want to learn, you actually care about what I'm giving you, and like you're here, like you're ride or die in it, you can definitely help out the series, innit? Like it doesn't take a genius to screen record or like download the video, chop it up, slap it on TikTok, innit? Hashtag is Daniel FX, and the video will gain a little bit more traction, gain a little bit more engagement. And then I'll be much more motivated, much more inclined to drop more consistent bootcamp episodes and also give you guys everything because the video will be performing, you guys will be learning, it'll be a win-win, everyone's happy. See what I'm saying in it? So I scratch your back, give you guys free value, free info. You can help mine out. Couple TikToks. Again, it's free, doesn't cost you anything, just a little bit of time. And again, everyone's happy. Because again, if I continue to drop these videos and even like the simplified versions and they do terrible, I'm probably just gonna slowly fizzle out with them as it is, isn't it? But anyways, we're gonna leave it there and let's get into the technicals because you guys are here, episode 4, day 4 of the boot camp. Now, real quick, just before we get into the technicals, let's recap what we done in the last session. So last lesson, what did we cover? We covered market structure. So we're talking about higher highs, higher lows, like uptrends, downtrends. And we were covering key levels towards the end of that session. We also went through some other stuff like DXY and like market sentiment. But again, that was covered in our last video. So we're going to continue to build off of some new concepts in this one. And we're going to briefly come back round to the key levels and quickly go back through the key levels because I know in the last session I kind of barely touched on it and we moved off. So just to give you guys a quick recap of how I like to draw my key levels. Again, I always, everything is always going to be done in a trending market. Again, so whenever I draw this little example right here, and you're like, yo, why is this guy always drawing this little 3 movement to the upside? It's just a trending market. It's the easiest example I can give you. It's an uptrend. Everyone can see what an uptrend is. Vice versa, I can flip it. It can be a downtrend. But in a trending market, you're always drawing your key levels from 1 of 2 points, either previous structural high, like this, or previous structural low, like this. In the event that your previous structural low gets broken, so you've broken a high and you've broken a low, meaning both these points of structure, this one right here, and you break this point of structure, then you're more than likely looking for a change of character and you may be looking for price to go in the other direction. Again, we're not quite going to cover change of character in this session. We are going to get into that, but that's for, like I said, for a further video. But those are your main 2 key levels. Now, there is another way that you can draw your key levels as simply based off of what I like to call an accumulation. This could also be called a depletion box. Again, it depends who you ask, but let's just call it an accumulation. So hopefully everyone knows what an accumulation is, but this is when price moves sideways. We consolidate and we don't break structural highs or structural lows. Now, again, pretty self-explanatory. Your key level would simply go at the top or it would go right here at the bottom. Again, with the system that I'm going to be teaching you guys, or the simplified version at least, we're only looking to trade in one direction. We're only looking to trade with the trend, with momentum, which means that you'd only be drawing one box on either side in it. And your other box, for example, if we're in like an uptrending market right here, you would only draw the structural high, or you only draw the resistance box, and you would leave this for potentially like a liquidity grab or something. Again, we are going to get into those concepts at a later stage, at a later episode, but just to give you a heads up, that's kind of the formatting you would be doing. But let me give you guys a quick little summary of how we actually use the key levels. Obviously, we're going to have an actual chart example here in a minute. I'm going to give you guys some further analysis on that. But just to give you guys an idea of how we start to fit together the plan. So you're starting off, like we said in the last episode, we're always starting off on the daily time frame. We're looking at market structure and we're looking at market sentiment. Once those 2 things align, and only once those 2 things align, you're then beginning to scale down into a smaller time frame either the 1 hour or the 4 hour, depending on how long you're trying to hold your trade for, and you would identify a key level. I'm going to show you this here in a minute. So right here, let's just take current price. Let's take current price action. So if I came into this market, I start on a higher time frame, I'm looking at the daily. This is on the basis that the dollar sentiment is doing what we need it to do, because right now I just can't be asked to go to the dollar. So if you guys watched the last episode, you know what I'm talking about as it is. But bear in mind the dollar is correlating. So we come to US 30, we're looking at market structure, market sentiment. Now, market structure, what is it in this example? Is it bullish? Is it bearish? Gonna give you guys a second to think in your head. Okay, cool. It's bearish. Now, if you said bullish, you're incorrect. Even though this is a bullish movement, and overall structure, wait for the ambulance to go past, overall structure is bullish. So I do agree in that extent. But again, remember, we're on the indices. The indices are quick. It's Barry Allen. It's like the Flash. If you know, then you know. But we're only looking at the past 2 weeks, the past like 12 candles. And the past 12 candles, simply put, have been this little accumulation movement right here. So if anything, I would say we're actually in a sideways moving market. We're in a retracement, but this piece of price action seems to be forming lower lows and lower highs. Now, notice what I said on episode 1, or like it was actually episode 2 when we first started the technicals. But what was that concept we spoke about? Elliott wave theory, impulsive and corrective waves. What happens? The market moves in 2 waves. We have the impulsive push right here, and then guess what happens? We have the corrective push that slightly counters the impulsive. So a large impulsive to the upside and small corrective back down. So again, even these concepts do apply to a higher time frame. They do apply to a daily, and the corrective moves on the daily tend to be the long consolidated weeks, isn't it? And that's currently what we're seeing right here. So this is an example of a market that I would say is a bit shit to trade, really and truly. I would say it's bearish market structure, and the current market sentiment looks a little bit weird as well. Current market sentiment looks like we had a bit of a attempt to take out the structural highs, and then on Friday we gained a bit of momentum. All in all, this to me looks like a weird market, just wouldn't trade it. So let's find you guys a different example right here. All right, cool. Now this right here is a day that I would personally trade on. So again, coming back to the start, the dollar sentiment is in line. The dollar is doing what we need it to do. We're looking at market structure, market sentiment. So the current market structure of this market overall is bullish, and current market behavior, I would say, is also bullish. Again, looking at the past 2 weeks, past 12, 14 candles ish, this would be the movement. We've had a structural push to the upside, retested the previous high. We were unable to break it on the first attempt. We then had a push to the downside, retested the lows. Once again, price was unable to break the lows. We respected this previous level, maybe a previous order block. Again, we'll get into that at a later stage. And then we then had another push to the upside. I can see that right here, current price action is attempting to have a closure above this candle wick. Now, usually, typically speaking, I'd actually wait for price to clear the wick before I actually consider it a proper like clearing of the high. But when it comes to key levels and when it comes to identifying a break above a level, especially on a higher time frame, I'm only really paying attention to the bodies. The wicks aren't really entirely important to me. Again, there are certain contexts where you may want to look at the wicks. But typically speaking, if you're drawing a level on the daily, which I very rarely do, I don't like to draw my levels on the daily because they end up too big. But in a situation like this where you can blatantly see, like, cool, there's a structural high right here, another structural high, 2 bodies that happen to close at the same level. Like, to me, it's pretty obvious there's some sort of key level right here. And that's how I draw it. Now, the reason that is this size, and again, coming back to what I said in the last session, always drawing the zones, the key levels, from body to body. You're trying to line up as many bodies as you can. You're trying to encapsulate the candle. So you see right here, I line up these 2 bodies from the bottom, and then I lined it up with the top of this body right here. Also, these line up pretty nicely, etc. Again, it's not always going to be perfect because the market doesn't always close at the same level, but you can see what I'm saying. Same thing if I was drawing a level down here. Again, just from body to body, just encapsulate the bodies right there. See how I encapsulated this little doji candle, and it also conveniently lines up with these body closures as well. So that's how I draw it. Cool. So market structure, market sentiment, both in the same direction. Now, at this point, you would begin to scale in to either the 1 hour or the 4 hour and identify an intraday key level. Intraday key level. Now, when it comes to identifying an intraday key level, what are you actually looking at? What are you actually paying attention to? Now, you need to understand that you are no longer trading the Forex pairs. Whatever you were previously doing on Forex pairs, whatever retracement you're waiting for, you need to understand that US 30, NASDAQ, German 30 have entirely different characteristics. They move entirely different. They have different behavior. What that means is a normal retracement, quote unquote, a normal retracement for like GU means it may come the whole way back down to previous structure and it may retest and it may have this long extended movement. But the indices, again, have their own unique behavior and you typically don't tend to get deep retracements. So when it comes to the indices specifically, and again, this is why I always start my trading analysis around New York session, you want to have your level as close to current price as it currently is. Now, I'm going to show you what I mean by that in a second with a little example. But I mean, for example, right here, again, let's get it in the right timing, so I can actually show you a good example. Let's skip forward towards New York. Cool. Skip forward towards, okay, right here, New York. Actually, no. To be fair, this example right here actually makes sense. So I would usually, in this sort of scenario, because again, this is now 12, so we're around New York Open. We're about presumably like 30-40 minutes. As soon as you zoom in, price are going to start moving. You'd be looking for a key level around current price. So again, we're only looking to buy in this example. We're only looking to take price higher. Therefore, you'd be looking for a key level below. Now, we do also have the daily key level that we drew, and that's the daily key level that we can see right here. So we're keeping that into account while we look for the intraday key level. Now, you need to understand, because this level was drawn in the daily, it's not going to be respected on the hourly. It's going to get broken above, broken below. Like this level is pretty much not here on the hourly, but it's more of a daily zone that we're paying attention to. So again, on an hourly time frame, where's the next reasonable place that price is probably going to come to before we have a breakout to the upside? Well, to me, again, coming back to lesson one, because everything comes back to the foundation. Lesson one, what has happened right here? We've had a large impulsive movement to the upside. So impulsive push to the upside, and then what's happened? We've had a counter trend corrective. So we've had this little consolidation, accumulation movement back down. Now, yes, there is some fair value gaps in here, and yes, there is an order block here, which are two concepts that we're going to get into and build upon. But currently, we'll just disregard that. But again, price is just having a corrective movement back down. Now, where's the most likely place that price are going to stop the corrective movement before we continue back to the upside? Well, in my opinion, it's probably going to be one or two places. We're either going to respect this daily level and maybe start to show a reaction here, potentially, and then have that movement, or we're going to go in for a slightly deeper retracement, which would be way back down here before we come up. So in this sort of scenario, I would personally draw my level from the structural low, because this level seems to make a little bit more sense for me. However, because this is US 30, I'm always looking at a higher level first. I'm always going to not assume, let me not use the word assume, but I'm always going to anticipate that price can hold the higher level. Because again, US 30, one of its major characteristics, you don't tend to get very deep retracements on it, which means that I can be sitting there waiting for this retracement and it may never happen. We may just immediately break above and like get moving. You see what I'm saying in it? So you're always looking at the higher level, wait for the confirmation, wait for that change in sentiment, wait for some other things that we haven't been through, like depletion and whatnot, and then take the trade and just assume that it's going to hold. And again, not assume, anticipate, not even anticipate, trade the confirmation. That's what we're doing. We're not assuming anything. We're not anticipating anything. None of the strategy I'm teaching you guys is about anticipation. A lot of strategies you guys may have traded before is about finding a level and anticipating a movement. You're waiting for price to come here, and then as it comes here, you're like, I think it's going to come here, or I think it's going to go here, or I think after we do this, we're going to do this. That's called anticipation. That's you like trying to predict the market essentially. How I trade is I like to react to it. I like to see bits of information. I like to see what I call confirmations. And then after I see those confirmations, I act in accordance with that information in it. So I'm only ever acting off of current price and current like info that I'm getting, if that makes sense in it. Again, to an extent, there's still an element of I'm anticipating a certain movement because obviously I don't know the outcome, but it's different to the extent where I'm not anticipating entire movements, rather just the continuation portion, if that makes sense. But right here, you can see we zoomed into an hourly time frame. So now we've got two levels. We have a daily key level and we have an hourly key level. Now, at this point in the trading plan, what you want to do is you want to scale in further and you would wait for the behavior around New York. So you'd maybe scale into a 5 minute and you would start to wait for price to have some sort of movement. Now, once again, I am paying attention to the fact that this level that we drew down here is a decent distance away. We're pretty far away from this level, which again does not give me a lot of confidence that we're going to hit it. So you'd be sitting there and you'd be waiting for price's behavior. You can see we've opened up for New York. Price attempted to break structural highs. We attempted to break higher, came back down, attempted to break lows, failed. currently still in an accumulation. So you'd sit here and you wait for the behavior. This is more likely another stock exchange open, which is another thing that we're going to get into. But yeah, you would sit here, you would wait for price to move, you'd go to the 5-minute time frame, and you'd start to identify the next couple steps in the plan, which we're about to get into here in a minute. For those of you who know, for anyone who's been on a learn and earn for like the past year, who's seen any live trading from myself, you know exactly what this setup is right here. You know exactly what this formation is right here. This is actually my favorite trade type, and it's called the 3-pin breakout. I'm not going to go into depth on the 3-pin breakout because that's honestly the piece de what's that shit called? Pretty much it's just top tier shit in it. It's just top tier shit. This setup right here, my favorite trading setup, is my highest probability trade that I like to take. Passed me many challenges, many fundeds, made me lots of money. I love this setup right here. I may get into it, but if I do, it will be at a later session. If I do, it'll be at a later session. Or maybe this is a bit that I just keep to myself for the time being. But yeah, I would have explained this, but I'm still debating what I want to show you guys and what I don't. So for the time being, we're going to leave this and just move on to a different aspect. All right, cool. So currently, I don't know how long this video is right now because I can't see a timer, but I'm not trying to make this video incredibly long. So we're going to look to wrap it up within the next 10 to 15 minutes. There's still a couple of things I want to cover in this session, but I want to have a little talk with you guys in it. So currently, what you've learned from this like Indices bootcamp is impulsive and corrective waves. So a little bit of Elliott wave. You learn some beginner market structure, learn a little bit about key levels. Again, all of this stuff is very foundational concepts. But I promise you, with the information you already know, with the knowledge of impulsive and corrective waves, along with market structure, market sentiment, DXY correlation, and just identifying key levels, if you built that into a system, if you found a systematic way to do the same thing every day, that in and of itself could make you profitable. Now, I'm not saying that you go ahead and just trade this because there's definitely a lot of better ways to trade. There's a lot more systemized, like refined methodologies out there. But I'm saying this in and of itself could definitely make you profitable. The reason that I say this is, again, to remind you guys that this is not the important part right here. What we're learning right now is honestly irrelevant. Really and truly, it's honestly irrelevant because everything comes back down to the psychology. It all comes back down to the approach to the market. It's how you do it. It's how you can actually implement your system and not shit it every time you take a couple losses and not get cocky every time you take a couple wins. It's about you and how you are able to trade the system. So it's not actually the technicals. And again, I know I've been saying this, but it really is a major aspect to this. That if you have the good psychology, if you have a good mental grip on yourself and you're self-aware and you're accountable and you can hold yourself to what you say you're going to do, you can just trade with very simple technicals and still make a good amount of money. See what I'm saying? Yeah. Now, what we're going to get into is some session characteristics. We're going to get into some trading behaviors and how you actually want to begin to approach your trading. Now, in the meanwhile, with what we've currently learned, and again, I know it's not a crazy amount, still very beginner technicals for the time being, but what I want you to do after this session, go to FX Replay, sit there, and I want you to go to a daily time frame and again, practice daily structure, daily sentiment. Be very selective. Again, you're not looking to trade every day. Like you shouldn't have like 30 trades in a 1 month period, for example. You're looking at anywhere from like 4 to 8 max. See what I'm saying? Very, very selective. But start there on the daily time frame. Start looking for structure. Start looking for sentiment. Start zooming in, scaling in, and refining your key levels. Find a 1 hour point of interest. And for the time being, just wait and see how price reacts to it. Wait, like start drawing key levels. Let price come to it, see how it reacts, and start to get a better idea of US30. Get a better idea of the behavior, how it likes to react to certain levels. Because again, if you've been trading Forex for a decent while, you have an idea of how price moves. You have an idea of how the behavior is, of how it reacts to certain things. But again, that is entirely different on the indices. And the only way you're able to learn these characteristics and learn the behavior and learn all of this is if you begin to program your subconscious brain via repetition. Now, it takes 10,000 hours for you to be an expert at anything. And I think that applies to any system as well. So if you really want to master a system, you need 10,000 hours looking at price through the lens of that system. And you guys are obviously new to this system. So if you want to get good at it, you need to start getting in these repetitions from now. Now, I know this is very basic stuff and I know we haven't covered a crazy amount, but if I give you guys the advanced technicals now, if I give you guys like the more in-depth things now, you're going to disregard all the foundational shit. You're going to disregard impulsive corrective waves. You're going to disregard just basic market structure, higher time frame sentiment, DXY correlation. You're going to disregard these these beginner concepts and you're going to move to the things that you believe are more advanced because you think they work better, but it doesn't actually work like that. You see what I'm saying? This, if anything, is more important than the smart money concepts I'm going to teach you. Market structure, reading candle sentiment, reading market structure. I just said that, but yeah, the foundational shit is so much more important than these smart money concepts. It's so much more important than fair value gaps, than imbalances and efficiencies and liquidity. All of this, yes, it is additional confluence. Yes, it can give you a better edge in the correct context, but again, it's not necessary. You see what I'm saying? So for the time being, go ahead and backtest this. And just before we wrap up this session, we're going to go through some session characteristics for you guys to backtest as well. Now, there's two types of characteristics. I would say there's a weekly characteristic, which is a day-by-day thing, and there's a session characteristic, which is how price reacts from session to session. Now, I'm first going to start off by giving you session characteristics. Now, we're primarily talking about US30 here. NASDAQ will react in a similar way to US30, but their price action tends to be a little bit more stretched out. And German 30 is its own thing, really and truly. It does react very, very similar to US30, but if you want to learn specifically German 30, backtest German 30. Just a little bit of a heads up if you do want to trade German 30. German 30 is much more of an intraday pair, which means it's like the indices, but just on a higher time frame, essentially. So anything you'd be doing on a 5 minute, you'd maybe do it on a 15 or a 30 minute, and you just extend your SO and extend your target. Again, we're going to be getting into that once we start to look in depth about German 30 and how you can approach that. But there is a time and a place to trade that. But yeah, what was I saying? So weekly characteristics. Monday, and again, I'm speaking for the indices right here. This is just what I've learned over however long I've been trading it. But Monday, 9 times out of 10, actually not 9 times out of 10, let's say 7 times out of 10, Monday's a corrective day. So however Friday ended, if Friday ended as a strong bullish movement, Monday naturally wants to correct Friday's candle. So if we had a strong push on Friday to the upside, naturally Monday opens up and we have a little corrective back down, and we're trying to fill out the Friday candle. This is not always the case. Certain times, and there's usually a reason for this, usually just very high volume, but certain times you open up Monday and immediately get a continuation of Friday. Those sort of days are, again, they're very rare, and usually you can't really trade them as it is because price just doesn't give you a retracement and you're just sitting there looking at price ripping like, ah, shit, mate. But you see what I'm saying? So yeah, Monday, usually a correction. You can trade the corrective move, you can trade the pullback if you know it's going to happen. But usually you're going to get trapped in a consolidation, and Monday's was a little bit of an iffy day. It's either great or it's just a straight accumulation. There's no in between for it. Tuesday, great day in the markets. Tuesday is one of my favorite days. Tuesday is the continuation day. So 9 times out of 10, if you had a Monday correction, Tuesday is going to start the breakout. Tuesday is going to start the movement. However, if on a higher time frame, you're going in for a deeper retracement. So let's say you've just broken a structural high. Monday starts to pull back, and you see, cool, there's previous structure here. We're probably going to continue the pullback for Tuesday. That's what it's going to be in it. Tuesday is a continuation day, and it likes to continue what Monday done. So if Monday corrected, it may continue the correction, and then that leads into Wednesday, which is the midweek reversal. So again, it's just a very regular market cycle in it. You have the Monday open up, starts the correction. Tuesday continues the correction. It meets at point of structure. Wednesday, midweek reversal, breaks out. That leads into Thursday, Friday. It continues the market. You see what I'm saying? Very, very common characteristic. Again, I don't want you to fixate on this. I don't want you to fixate on the idea of Monday, Tuesday correction, Wednesday reversal, Thursday, Friday continuation. But that just is a very common theme, especially in a trending market, especially in a strong trending market. Usually you're going to have that Monday, Tuesday retracement at the start of the week, that little pullback. You're going to have the Wednesday reversal and then the blast off on Thursday, Friday. So again, with these characteristics and with the knowledge of this, you can start to plan your trades around these certain like turning points in the market and start to plan specific trades on certain days. Now, I don't want you to take my word for this. I don't want you to just sit there and be like, okay, cool, I'm going to reverse my trades on Wednesdays. But actually go ahead in your backtesting and start to look for this, start to look for evidence that Wednesday or that these specific days have certain characteristics. And I really recommend when you actually backtest, make a note of the day and make a note of what happened on that day. See what I'm saying? Because that's how you're going to learn the characteristics. That's how you're going to learn the behavior of this sort of market. Besides from that, we have session characteristics. When it comes to US 30, NASDAQ and German 30, London's not a great time to trade. London's only good for German 30. German 30 is acceptable to trade during London, but US 30, NASDAQ, I would avoid trading it during London. There is volume, you can make a move, whatever, but usually London's characteristic is a fake out. It just likes to grab liquidity from Asia and you just end up getting caught lacking. It's very difficult to trade London. So I would just recommend don't do it. You're trading the wrong session to be traded in London. So sorry, I mean you're trading the wrong instrument to be traded in London. Doesn't make sense. So we then obviously have New York that starts at 1 p.m. GMT, so UK time, 1 p.m. New York's obviously the most ideal session to trade the indices. You have the largest breakout movement during the first hour and the last hour of session open, session closure. So ideally, with this strategy, you're looking to enter your trade at 1. So around 12:30 to like 1:30, that first 1 hour of New York Open, you're looking to enter your trade by then. If you haven't entered the trade by like 3 or 4 p.m., there's probably not a very nice trade there for the day, and you're probably done for the day. So that's like your time window to trade. You're looking at the first like 2-3 hours in New York. Now, if you never traded the indices, 2:30 every single day. So this is an hour and a half into New York Open. You have stock exchange open. Now, this is when obviously the stock exchange market opens and you have a huge volume candle every day guaranteed. It's like a little mini news event. Now we're gonna have an entire session about stock exchange at a later stage, but it's a very volatile movement. It can either make you a lot of money, like crazy 1 to 10, 1 to 15 movements, or you can get ripped to shreds in like a matter of seconds in it. So it is a very, very difficult move to trade. For the time being, I'd recommend if you're backtesting or you're actively trying to trade the indices, avoid it for now. Don't be in a position at 2:30, and maybe like leave 2:30 to like 3 o'clock alone until the momentum dies out. But like I said, we're going to have an entire session about that on the next one. But listen, just before I wrap up this video, like I said at the start of the video, if you guys are actually here and you're serious and you want to learn, you want me to continue this series, you want me to continue to give you guys more value, more free info, all of that stuff, you know what to do in it. Literally download the vids, chop it up, slap it on TikTok, hashtag is Daniel Effects. Do anything. I know you guys are creative. I know you guys have got the time. I know a lot of you guys actually know what you're doing on TikTok. It's not that difficult, innit? It's really not that difficult. Everyone wins. You guys are happy. I'm happy. Gang shit. See what I'm saying, innit? But I'm going to catch you guys in the next video. It's up to you when that next video is. Episode 6 of the bootcamp.